If you've looked at the global economy lately, you know exactly what the biggest, loudest noise is. AI, artificial intelligence. It's a phenomenon that has rewritten market capitalization records, seemingly every week for the past couple of years. We've seen a handful of technology companies just put up these dramatic performances, driving the entire market higher and higher.
It is absolutely the defining story of our economic era. But here's the essential, I think, brutal question we need to spend this deep dive unpacking.
Going.
Are we witnessing a true technological boom, one that, fundamentally unlocks a new era of global productivity? Or are we instead experiencing a structurally fragile bubble that is poised for a devastating pop?
That is the mission today. And the stakes are truly staggering. We're talking trillions of dollars, stability, the entire global financial system. We've taken the source material you shared with us to dissect not just whether it's a bubble, but what the specific economic fallout might look like if the hype fails to deliver.
Exactly. If this whole concentrated capital structure breaks, do we end up with a severe recession, something like 2008?
Or something different, like a whole new wave of inflation in Inflation 2.0.
Well, the entire market equilibrium right now, it really boils down to one monumental bet. The future relies entirely on generative AI not just succeeding, but delivering on its massive, unprecedented promises.
And doing it fast.
Way faster than the adoption curve of any previous foundational technology in history.
Okay, let's unpack this with some scale, because
Yeah.
the figures are genuinely difficult to even contextualize. Since the generative AI wave, powered by models like ChatGPT, went mainstream, AI-related companies have collectively added roughly $19 trillion in market value.
19 trillion. It's a colossal injection of capital, and it's based largely on future expectation.
And that capital shift is far from evenly distributed, right?
Not at all. When you look at the financial snapshot for 2025, the source material shows that AI names accounted for approximately 80% of all U.S. stock market gains.
80%.
That means nearly all the value creation in one of the world's largest financial systems was driven by a single sector, and really a small cluster of companies within it.
This concentration is where historical analysts begin to get very, very nervous. By late 2025, just 5 mega-cap firms,
The big ones.
the undisputed AI leaders, made up about 30% of the entire S&P 500.
And to put that 30% figure into context for you, that level of market concentration is a rarity, a real rarity. If we connect this to the bigger picture, you really have to go all the way back to the extreme peak of the dot-com bubble in the late 1990s to find a similar market structure.
So the danger isn't just the high valuations.
No, the danger is systemic. When such a small group of stocks carries that much disproportionate weight, any isolated risk, any correction in that one sector can instantly destabilize the entire global index. The market's vulnerability is just concentrated.
And crucially, this isn't just paper money moving around on a stock exchange. The trillions are funneling into real physical infrastructure. Analysts are calling this an AI capital expenditure supercycle.
Right. Huge amounts of money are being poured into building the physical backbone.
Things like vast data centers, specialized AI chips.
Power grids to run them, massive cloud build-outs across the globe.
What's fascinating here is how it's being paid for. The financing mechanism.
Yeah, to fund a supercycle of this size, a significant portion is being supported by debt, which is standard.
But also something else.
Increasingly, by something more complex, circular business deals. This is where the companies financing AI infrastructure are often the same ones selling the chips and the software.
Okay, that sounds complicated.
It creates explosive, rapid growth, but it also introduces a kind of structural opacity. It's hard to see what the actual independent demand is.
Which brings us directly to the bubble argument.
Yeah.
If you listen to the critics, they point to valuation extremes that they defy traditional logic. For instance, a leader like NVIDIA saw its market value jump roughly 300% in just 2 years.
And we have to remember the broader context here. The S&P 500 is already trading around a 23 times forward earnings, which is historically stretched.
Already high.
So when you have a few specific AI leaders trading at multiples far beyond that, what you are essentially observing is investors pricing in a productivity miracle. It raises a really important question. What exactly are they anticipating?
Well, the critics argue that investors are pricing in an impossible, flawless future.
Exactly.
They are behaving as if AI will be adopted by every single business globally, that it will massively boost productivity overnight, and that it'll do so faster than any previous technology.
Faster than the internet, faster than electrification.
It's the absolute best-case future, isn't it? One where every single variable goes right immediately.
And there are virtually no regulatory, economic, or adoption hurdles. That leaves very, very little room for error or disappointment.
And economists are starting to issue warnings about speculative demand. They see that much of the demand for AI chips and services isn't based on current proven profitability.
Not on tangible, realized returns.
Instead, companies are buying capacity just because they're terrified of being left behind. It's FOMO, fear of missing out, driving the capital expenditure.
And that is textbook bubble behavior. When investment is driven by the fear of missing out on a future technology, rather than the established current value it provides.
Yeah.
The whole structure becomes fragile.
So you're building massive capacity based on speculative fear.
Way ahead of a time when realized returns have actually caught up.
It sounds like we are building this massive economic edifice on expectations alone. And yet, the counter-argument is remarkably robust. It's why those 5 mega-cap companies continue to dominate. Major banks and strategists argue AI spending is rational, not reckless. So how do they justify these valuations? How do they distinguish this from the disastrous dot-com era?
Well, this distinction is absolutely critical for you to understand. Unlike the dot-com startups of the late 90s, the cash-burning garage operations with little revenue.
Right, no path to profit.
Exactly. Today's AI giants are trillion-dollar corporations. They are highly profitable, cash flow positive, and diversified across multiple industries globally.
So the key takeaway here is that this isn't about buying some speculative IPO. We're analyzing whether established, stable giants are being overcapitalized. They're betting from massive balance sheets, not just borrowed funds.
That's the core of it. They are leveraging proven business models. And if you look at the long-term revenue potential that analysts are modeling, the numbers are just astronomical.
How astronomical?
Firms like Goldman estimate up to $19 trillion in long-term capital revenue flowing from AI. When you put a $19 trillion potential future against current market caps,
then the high valuations start to seem justifiable.
Some strategists argue they become rationally justifiable if, and it's a big if, that future materializes.
This raises a big question for the largest institutional investors, the ones managing pensions and retirement funds. They see the risk of being early, of course, but they argue that the risk of entirely missing the next foundational technology, like failing to invest in the internet or electricity, is far higher.
It's an asymmetric bet. The potential upside of being right on AI is generation defining. The downside of missing it means permanent relative irrelevance.
So the core choice for you, the listener, becomes framing the situation.
Is the current market activity one of pure irrational excess? Or is it simply early investment into a guaranteed foundational technological shift?
That distinction really crystallizes the debate. And if we look at a specific case study, the tension between boom and bubble, it really centers around a company like NVIDIA.
Right, because of its role as the key supplier of the most crucial hardware. Its valuation depends entirely on the continued explosive demand for its specialized chips.
But analysts are now intensely focused on the financing structure they've used to fuel that demand, especially for data center construction.
They are.
So tell us more about that circular financing detail, because this is one of the biggest points of anxiety in the source material.
Okay, so the documents indicate NVIDIA is planning around $100 billion in data center commitments globally. And they often achieve this through deals where they strategically fund or take equity stakes in AI infrastructure companies, their key customers.
Okay.
Those infrastructure companies then use the capital they just received to buy massive orders of NVIDIA chips and hardware.
Wait, so if I'm an infrastructure company, I get funding from NVIDIA, and I use that exact funding to pay NVIDIA for chips. It's a closed loop.
It is. It artificially accelerates growth.
What does that structure hide?
Well, while it looks like a clean sale on the income statement, it raises profound questions about the organic nature of the demand. Are the chips being bought because customers have a proven profitable use for them?
Or just because the financing was made available?
Exactly. It makes it extremely difficult to determine where genuine profitable demand ends and where strategically engineered demand begins.
That insight adds a layer of structural risk that goes way beyond traditional TE ratios. And we know this anxiety is real because we've seen high-profile investors, people like Michael Burry and Peter Thiel, openly signal skepticism.
Taking profits or betting against some of these AI leaders, that suggests the smart money is hedging its position. They're recognizing that even if the technology is real, the valuation may be running ahead of itself.
And Wall Street is now increasingly discussing the threat of an everything bubble. What exactly does that imply?
It's the concern that AI tech isn't an isolated problem. It's that stocks across the whole tech sector and even parts of private equity and real estate, they all look richly valued at the same time.
So if one major domino falls,
Say a significant write-down in AI data centers, the resulting shock could trigger corrections across multiple asset classes because the risk isn't siloed.
yet despite all these risks, the largest global asset managers continue to hold their positions.
They keep returning to that core belief. They acknowledge the risk of being early, but they reiterate that the cost of being wrong on AI, the cost of missing this historic shift, is simply too big.
Staying invested because the potential reward outweighs the immediate risk.
That's their argument.
Let's pull back now and look at the macro backdrop, because this whole AI boom, whether it's rational or speculative, is happening in a very specific economic environment. The global economy is still fragile.
That fragility is the danger multiplier. Global growth is slowing, it's sluggish. Inflation, while cooling, is trending toward 2 to 3% in most advanced economies. Central banks have very little maneuvering room here.
This boom is happening atop an economic structure that's already sensitive to shocks.
And tightening credit conditions, it's a delicate balance.
And crucially, business leaders are aware of this.
Yeah.
The McKinsey December 2025 outlook, cited in the sources, shows that more than half of executives surveyed now see a recession as the most likely path for the next 2 years.
So market exuberance is running headlong into serious executive apprehension.
Which means, what happens if the AI bet stumbles? If that engineered demand disappoints? If data centers are overbuilt or the circular financing model breaks?
Then the source material suggests this leads to a sharp financial shock.
If the bubble argument proves correct, we could see massive write-downs on assets, significant credit stress as that debt becomes untenable.
Widespread tech layoffs.
And this financial shock would push the global economy into a recession by tightening credit and destroying confidence.
That whole scenario brings us to the 3 distinct economic futures that analysts have laid out for you. 3 clear paths to consider.
Okay, scenario number 1, the soft landing. This is the optimistic path. The AI hype deflates slowly, valuations compress gradually, and crucially, those promised productivity gains actually start showing up.
Right. Inflation drifts gently back toward 2%. Central banks manage careful rate cuts. This is the no-crash managed adjustment.
Scenario 2, the AI bust leading directly to a recession.
This is the painful pop. Confidence breaks sharply, funding freezes up, those expensive data center projects get canceled en masse, credit markets seize up, and the global economy slides into a classic downturn, likely hitting hard in 2026.
And then there's scenario 3, the crash leading to inflation 2.0. This is the most chaotic one because it's counterintuitive. A market fall usually means deflationary pressure.
But here, the path to renewed inflation is through government panic. In this scenario, the markets fall dramatically, governments and central banks panic, and they flood the system with enormous stimulus to prop up employment and asset values.
All that new money chasing the same amount of goods.
Exactly. The result is inflation roaring back later in the decade, driven by high debt and panicked spending. The disinflationary benefit of AI is just overwhelmed by the transition risk.
So when we put it all together, what stands out to you now? Is AI a once-in-a-century productivity boom that's just getting started, justifying that $19 trillion surge? Or is it the biggest, most concentrated bubble since .com, with a recession or even renewed inflation waiting on the other side?
Ultimately, the market will soon answer one brutal question about this unprecedented concentration of wealth and capital we've witnessed. When we look back, were these trillions in AI spending the smartest, most necessary investment of the decade?
Or the most expensive mistake?
Or were they the most expensive mistake, artificially fueled by circular demand and fear? That answer determines which of those 3 economic scenarios we just outlined becomes the dominant reality for your future.